Good morning or afternoon, depending on where you're joining us from. Thank you very much for joining us and welcome to this Fastmarkets webinar. Over the next hour, myself and the analyst team are going to provide you with our view on the battery raw materials markets. Next slide, please. I'm Paul Lusty and I look after the Fastmarkets battery raw materials research and analytics area that produces our shorts and also our long-term forecasts and related outlook products. We've got an expanding global team. There are more than 20 analysts that provide market analysis, forecasts, cost assessment, but also consultancy on the battery raw material markets. All the slides from today's webinar and also a recording of the event will be available to everyone who's registered, and the link to that will be circulated later today. Next slide, please. This is the agenda for today's webinar. We've got 7 of our analysts joining us to present on their markets. We're going to start off with a look at battery demand and the key developments since our last webinar back in May. We'll then have presentations on each of the battery raw materials in which the analysts will describe the key market dynamics at play and also give our forecast supply demand balances and prices for the various battery raw materials. We're also going to be presenting our battery cell cost modeling work and also our recycling and black mass market outlook. We're going to end the webinar with 10 minutes of questions, so please do post any questions you have for us in the chat, and we'll work for as many possible, either by responding to the questions in the Q&A or verbally at the end of the presentations. I'm now going to hand over to Connor Watts, who's going to outline our view on batteries and raw material demand.
Hi all, I'm Connor. I'm going to be going through our outlook for battery raw material demand, starting off with a brief overview of the last year, our forward-looking outlook, and then ending with some key considerations into the next couple of years. So I'm sure that everybody is quite familiar with the last year, and EV demand in particular hasn't been overly positive, but we see this particularly in Europe as both France and Germany electric vehicle sales have been less than ideal, quite heavily negative at times, particularly in Germany. And but it is good to say, at least now into October, that Europe as a region is back into positive year-over-year growth. And it's not to say that the overall demand outlook for the across the world has been heavily negative as well, because as always, China has been a key stalwart of EV demand, increasing EV demand by 35% year over year thus far. And going into the next year or so, we are expecting 2025 to be a little bit more positive on the European front, depending on the result of some key elections in both France and Germany, but it will also be supported by new emissions regulations. Some other key trends within the industry so far this year has been a continued shift towards LFP, particularly in China, though increased imports from China towards Europe in particular will also shift that again towards LFP battery demand rather than high nickel ternary batteries as once expected. Extended range electric vehicles have also been a pretty key facet of this year's demand, mostly in China, though we do expect this to follow suit in the US in particular due to their tendency to prefer larger vehicles and care less about high ticket prices, but Europe is also likely to as well, following some key joint ventures such as Leapmotor and Stellantis. Yes, so moving on to our mid to long-term outlook, we expect EV demand to continue growing year over year by 16% CAGR, but the wider battery market is likely to grow much faster than that due to the development of the energy storage market, which over the course of this year has grown 50% year over year in terms of battery deployments. We see this being a pretty key source of battery demand going forward, particularly as it's much less subsidy driven than the EV demand sectors. And so we see it as being more heavily insulated from policy uncertainty. And moving on to where else we will be seeing battery demand, we do expect a bit of a redistribution between the powertrain of EV demand. We've seen particularly this year in China that extended range electric vehicles are going to be a longer term source of demand, and the larger batteries of these are likely to be more supportive of battery cell demand within the country. Let's move slide. Thank you. This goes to September, and again, it's worth saying that Western Europe is now into a positive. But with China expanding its battery demand via extended range electric vehicles, we expect these to be quite heavily exported as well. So while it may not look like it from a battery demand perspective, both Europe and rest of the world regions will be utilizing Chinese capacity in ever more increasing amounts, even though that may not be their explicit desire. Finally, another consideration for this that's going to be quite paramount in the next year is going to be policy. Particularly in Europe with its new emissions regulations, we expect China as well to be supportive of further growth within its EV industry as it looks to support its economy further in the absence of the property market. But I think the elephant in the room in particular is the developments of the US market and how battery demand is affected, as despite having Elon Musk within President-elect Trump's cabinet thus far, we do also see a shift towards getting rid of its $7,500 EV tax credit. So sales within the US are likely to be a little bit negative going into next year. How that develops as well, we are looking at, and will be a very key factor going into the next couple of years. For it all. I think with that, it'd be wise to hand over to Will. He's going to walk you through the key developments in the coming years of the lithium salts markets.
Thank you, Connor. If we can move on to the next slide, please. We'll start by looking at the lithium price, what they've been up to. So this chart here shows you the lithium carbonate price in the CIF, China, Japan, Korea market. And you can see prices seem to be trying to form a base. If you look at the little inset on that chart, you can see a couple of times prices have now sort of bounced off the lows and are trying to sort of gain a bit of distance off the lows. 2024, though, has been a relatively quiet year for prices. Prices have held in a $5 per kilogram range, which is much smaller range than compared with sort of recent years, as you can see here on the slide. Last year, prices held in a $64 range, a $40 range in 2022, and a $30 range in 21. So we do sort of see the flatter prices suggest that a floor is in place. But it's worth mentioning that prices are currently 50% above the lows that we saw in 2020, which was $6.75 per kilogram. So the low so far this year being $10.50. The longer we see prices down at this level, then we're likely to see more production cuts. And if we move to the next slide, you can see the market is already trying to sort of rebalance. We've seen cutbacks at Chinese and non-Chinese producers. And in this chart really shows you how we see mine supply has changed since when we did our earlier long-term forecast in August, compared with how we see things at the moment. So you can see some significant drops in mine production. And we've seen lepidolite mines in China close down. We've seen Pilbara Minerals look to close their New Guangzhou plant starting in December. Mineral Resources is presently sort of putting its Bald Hill mine in care and maintenance. Mount Cattlin is going to be put into care and maintenance by the end of the first half of next year. Liontown has also sort of reduced their mine plan for Kathleen Valley, which will also lead to a small amount of reduced production. In addition to the mine cutbacks, we've also seen cuts to refinery production, and we've also had numerous announcements about cuts to CapEx. And that CapEx cuts, that will lead to some projects being delayed, work at some of the other projects being suspended, and indeed some projects have even been cancelled. So I think that, this is going to have some far-reaching implications, and I think the risk is it means that the West again ends up losing market share to China. But in addition to these cutbacks, with also some operations or projects are still ramping up. So it's not all one way. It's not just all the taps being turned off. We are seeing a bit of a mixture of that. And if we could move to the next slide, please. So what we're looking at, sort of, how is that going to change the outlook at the moment? So as Connor said, demand hasn't been that strong, but we do see it the weakness as being temporary. Generally, the outlook remains bright. And I think it's worth sort of looking at what happened to Germany and Europe generally, but Germany in particular this year, we have seen a slowdown. And that's very similar to the slowdown we saw in China in 2019. After China cut the subsidies, we saw EV sales were hit. And I think we've seen the same situation in Germany this year. So EV demand hasn't been as strong, but generally it's still robust. We see the outlook for energy storage system is still strong as well. So the combination of those two factors, plus the producer response we're seeing, means I think it's time to sort of look to see when the market is going to move back into a deficit. Now, this chart shows you our supply-demand balance forecast. This is from August. Again, we are in the process of reviewing that now. And whereas back in August, we were looking for the market to move into a deficit in 2027, we now expect that to be seen earlier. So we haven't quite finalized our numbers now, but we do expect the deficit to be seen sooner than 2027. And as I mentioned earlier, we are seeing production cutbacks. We are still seeing some ramp ups. So we're moving into a sort of a situation now where we're probably going to be stepping in and out of deficits for a while. But as the deficits get closer, I urge you to all sort of watch out for the sort of the restocking phase and the impact that can have on prices, because that can really give prices a boost. And with that, I'd like to hand you over to Olivia, who will be looking at nickel.
Thank you, Will. So if we look at the demand situation for nickel, we really expect the battery sector to lead the demand for nickel in the years ahead. And yet, for this year, we only expect primary nickel demand in batteries to grow by around 6%, and that's after a flat 2023. We estimate that primary nickel end use in batteries, that's the primary nickel in batteries contained in EVs and other battery containing goods that have been sold, to have risen by about 160,000 tons of contained nickel over the past 2 years, and that's to the end of our 2024 forecast. But we estimate that primary nickel first use in batteries, and that's the primary nickel going into PCAM production, well, that rose by only 27,000 tons over the same period. Now, this suggests a significant destocking of nickel somewhere in the battery chain. That could be at the PCAM stage, or indeed the CAM stage, within the cells, within the batteries, or even within the EVs. However, this destocking can only carry on for so long. And for 2025, we expect primary nickel at the PCAM stage to grow as rapidly as end-use demand. So as a result of that, we expect demand for nickel in batteries to rise by a combined 625,000 tons between end 2023 and end 2028. The battery sector is not the largest consumer of nickel, however. That's stainless steel. And here we've got an increase in primary nickel in stainless steel of 275,000 tons. And on the next slide, we'll just explain why. We expect crude stainless steel production to rise at a CAGR of 2.9% to 2028, but we expect this growth in production to be led by 300 series material. That's the high nickel containing stainless steel. And we also expect China to drive this growth in production. And that is important because scrap usage in China is relatively low at the stainless steel stage, which means that the mills in China are highly reliant on primary material rather than in nickel contained in scrap. So if we look at the next slide on the supply side, we expect total refined supply to rise at a CAGR of 3.3% over the forecast period after provisioning for possible disruptions. But this growth is going to be led by Indonesian production, which we forecast to rise at a CAGR of 7.7%, followed by China with a CAGR growth of 3.9%. Most of this supply growth will be nickel sulfate, which we expect to grow at a CAGR of 16.1%, followed by Class 2, which will grow more slowly, while Class 1 will grow, but at a CAGR of only 0.6%. Now, new Class 1 capacity will allow Chinese and Indonesian producers to switch between nickel sulfate and full plate cathode production, depending on demand and on payables. And in the case that both are low, this would still leave the option of delivering on the LME or on the SHFE as markets of last resort. Now, full plate cathode is currently being sustained despite the lack of demand because some producers are still awaiting for SHFE deliverability. The new producers have all received LME deliverability thanks to the exchange's fast track program. But we expect all new producers to have received SHFE deliverability towards the end of Q1 2025 or early Q2 2025. And after that, we would expect full plate cathode to start adjusting to the market's needs. So if we put all of that together on the next slide, we show the market balance. And this shows that the market is in the process of rebalancing from the significant surplus that we saw last year. For 2024, we forecast a surplus of 94 kilotons of nickel, which is still fairly substantial, but the production cuts that have occurred due to the fall in prices last year means that this year we expect this surplus to more or less halve to around 41 kilotons in 2025, and we expect this to be followed by a 41 kiloton deficit in 2026, with widening deficits thereafter. And on that note, I'll now hand you over to Robert Searle, who will take you through the cobalt market.
Thank you very much, Olivier. Yes, we're going to start off on the cobalt market on our first slide, having a look at some of the price trends that we've seen since our last webinar in May. And from these charts here, we're showing that the cobalt prices have remained under pressure over the last 6 months or so. We've witnessed ongoing challenges in demand, particularly in Western markets, where we continue to see shifts either towards higher nickel loadings or cobalt-free batteries, combined with slow manufacturing growth in these areas. Now, this has combined with continuous mined and refined supply growth upstream in cobalt and also on the refined side in China. In October, standard grade cobalt metal prices broke a psychological barrier, falling below $10 per pound on the low end. And at the same time, cobalt sulfate and tetroxide, we can see on the right-hand side, well, demand here hasn't fared any better either. From our most recent peak in May 2022, we see that standard grade cobalt metal prices are now down 75% in November. In China, this fall is around 66%. So the first reason for this we're going to unpack on the next slide is the mine supply growth that we've seen in the market. And this supply growth has significantly outpaced demand, particularly over the last couple of years. It's what's been driving the bearish sentiment and pricing in the cobalt value chain. Most of this has been seen in the DRC, but we still see Indonesia's year-on-year supply growth remaining very significant from the country's H-Power units, and this will continue in our forecast. Now, from 2021 through to 2024, we're forecasting an additional 115,000 tons of mined cobalt supply. But rather than fundamentals within the cobalt market driving these additions, this has been driven by supportive copper prices in the last 12 months on tightness in copper concentrate supply. We're showing this on the right-hand side here of the historical copper and cobalt pricing trends When we look from late 2022, we can start to see the cobalt prices continue to fall while copper prices strengthen on this tightness upstream. In 2024, copper prices have averaged 34% higher compared to the average from 2013 through to 2023, and this has incentivized mine extraction. Now, mine supply has grown, but on the next slide, we can show that refined supply has also been keeping up with the additions of extracted cobalt in the DRC and Indonesia. And refined metal supply has been the real driver here, and it's grown as chemical demand has remained sluggish in the last 18 months. In 2021, refined cobalt metal production made up only around 19% of the global total. But these end-use markets are typically much slower growth compared to EV and cobalt sulfate demand. So the feeling was that this would be a shrinking proportion. However, in 2024, we're forecasting that 28% of the total cobalt refined supply is going to be from metal. Now, almost all of this growth in refined metal production has come from China. In January 2022, the country produced just 450 tons of cobalt metal. Fast forward to October 2024, we see it producing in that month a little under 5,000 tons. And this has come at a time when the rest of the world cobalt metal production has grown just 1,400 tons from 2021 through to 2024. Now, the operating charts on the right highlight this shift here, with cobalt sulfate demand weakening and refiners shifting towards metal production and very high utilization rates. Now, with this metal production having outstripped Chinese domestic demand significantly, refiners continue to look to the export market. And this has lengthened the availability in the seaborne market and pressured the standard grade cobalt metal price to the lows that we're seeing today. So our final slide on cobalt, we put this together. And it's these factors which lead us to believe that we're going to see a significant surplus in 2024, with this persisting into 2025 and bearish prices expected to continue. The surplus is expected to shrink slightly in 2025, but overall, we are still expecting average annual standard grade cobalt metal prices lower in next year compared to 2024. Now, the market will be relatively well supplied and in balance out to 2029, but still tighter as demand continues to grow at a strong pace. The key points for us, for you to take away from this webinar today are the bullish and elevated prices in the copper market, which we expect to continue to incentivize DRC mined cobalt production in 2025. The ongoing headwinds and challenges for Western EV demand and cobalt thrifting in the battery sector. And finally, China, but more important, but also now Indonesian origin cobalt metal continuing to pressure prices in the seaborne market. I'll now pass on to Amy to talk about graphite and the anode market.
Great, thank you, Rob. We're coming to the end of yet another difficult year for the graphite market, as you can see here, with prices falling throughout the year and continuing declines that have been in place since mid-2022. Demand from both the battery sector and traditional consuming sectors has been sluggish and disappointing, but the true negative impact on pricing is coming from the supply side. Natural graphite prices have been coming under intense pressure from unrelenting competition from the synthetic graphite sector, with massive capacity increases in China and price cutting for market share, making it incredibly difficult for natural graphite producers to compete in the market. The one bright spot in the market has been Europe, where the graphite market has enjoyed price premiums this year, reflecting geopolitical concerns and higher freight rates, and indicating an emergence of ex-China market premiums, which is something that the market has really been looking for. So this is a positive development. However, overall, we're seeing prices below operating costs for both new and existing producers, which is clearly an unsustainable situation. And we believe, as a result, prices are at or near a pricing floor. On the next slide, we can see that prices have struggled while China has continued to increase its grip on the graphite supply chain, with Chinese producers adding and expanding capacity for both natural and synthetic graphite over the past year. We've seen China's dominance in graphite rise. I originally had created this slide a year ago in response to China's imposition of export controls on graphite and to highlight the rest of the world's reliance on Chinese graphite, particularly in the battery sector. A year later, China's dominance has increased. So not the direction that the industry would have hoped for. But China's share of global natural graphite production is now up to about 80% from 60% previously. And China's overall graphite active anode material market share is now at about 98%, up from our estimate of around 93% a year ago. So with the addition of significant new capacity, Chinese synthetic graphite producers have slashed prices to gain market share, eroding the traditional price premium synthetic graphite active anode material enjoyed over natural spherical anode material, and also eroding the typical cost advantage enjoyed by natural spherical graphite. In this background, on the next slide, we can see that clearly China's aggressive pricing strategies are pushing ex-Chinese producers out of the market. We've seen significant supply cuts coming from producers in both Mozambique and Madagascar. And really, a large part of the problem as China has been the main market for these fine flakes coming out of Africa. And with China increasing its own production, there is less demand for this material, and demand from North America and Europe is just insufficient to replace the Chinese market. So now we're seeing, obviously, inevitably, these pricing, the extended period of low prices causing these significant production cuts. And now on the plus side, in these cyclical commodity markets, including graphite, production cuts typically indicate a shift in the cycle. And on the next slide, we can see that with demand fundamentals largely stable, we believe graphite prices are now at or very near a floor. Our demand outlook remains largely positive, if not as optimistic as in previous years, and we expect only a modest slowing in US demand under the new Trump administration. We're cautiously optimistic for some modest pricing recovery next year as excess supply begins to be absorbed, with the recent cutbacks helping to accelerate that much needed process, and with the prolonged period of low prices expected to prompt additional cutbacks in the near term. But as you can see, we will remain in surplus next year. One thing we have seen is the premium pricing emerging this year in the European market, and we expect this to remain a feature of the graphite market going forward. We've really repeatedly expressed the view that a premium pricing structure is necessary to encourage the development of a localized and diversified supply chain, and we believe these premiums are now emerging in a sustainable way. This is largely influenced by geopolitical conflicts and protectionist measures, and we expect this to persist going forward. It's important to note, though, that although we do forecast some graphite price improvement in the coming years, this overhang of excess Chinese capacity, particularly on synthetic graphite, will cap Chinese prices below 2022's highs for the foreseeable future, although European prices may return to those levels in the latter years of the decade. And with that, I will hand you back over to Rob to give us our manganese outlook.
Thank you very much, Amy. So starting off, as we did with cobalt, with manganese, a little discussion around the pricing and the changes we've seen. So, the take home for us here is sitting in November, manganese sulfate prices have once again started to turn bearish in Q4 on continued slow PCAM spot buying in China. So since our last webinar, I think we would have touched upon the mine supply disruptions in Australia and weather-related damage. We see the prices there, so bullish raw material prices, firstly, increasing the high-grade ore price in China, but then also feeding through into manganese sulfate, despite the demand fundamentals not being overly bullish for in the market. Now, manganese ore prices start to come off in China around the middle of 2024, as we see more imports of material from South Africa and Gabon arrive. But the manganese sulfate price that we published was supported for longer, and the major reason for this being that processors remained out of the market, having cut back utilization rates in the face of the low prices. But here we are now in November, and again, as I mentioned, the slow spot PCAM demand persists within the HPP, MSN, high purity manganese sulfate market, with prices falling. So let's stick with this idea here of processors being out of the market, and we're going to move on to the next slide to discuss the supply picture, which China dominates, and why we believe that in the short to mid-term, China's supply base has room to grow and supply global needs of high purity manganese. So the chart is showing obviously the decline Firstly, in the pricing of manganese sulfate, ex-works mainland China, but the response in operating rate cutbacks from processors in the country. We currently see operating rates sitting at around 25% in October. Market players have continued to destock through much of 2024. And this is bullish for next year, of course, because we will require a restocking cycle at the same time as forecasting demands beginning to recover from the PCAM industry. So obviously, from the position we're in with very low rates, China's installed capacity has a long way to go and will be able to ramp up to fulfill the manganese needs in the short to midterm. For 2024, we're only expecting a mild increase in production out of China, but 2025 will see a stronger response. And through to 2034, we expect China's installed high purity manganese supply to grow from 4 times from 2023 through to 2034, as I say. Now, it's going to have to ramp up quite quickly in China because it has installed capacity. But as we move on to the next slide, we believe that we're going to start to see very bullish indicators and bullish demand growth for manganese from developing chemistries in the battery electric market. And LMFP is one such chemistry which we believe has the potential to revolutionize manganese demand. It's the reason we're extremely bullish on manganese loadings in the EV market going forward. Widespread commercial rollout is forecast to ramp up in the second half of the decade and into the 2030s. And we expect the chemistry LMFP to take market share from mid-nickel 622, but also LFP globally. The chart on the left is us comparing the energy density of current and developing EV chemistries. And we can see that significant advantage of LMFP over LFP, up to around 20% higher on an energy density level. This greater range makes us believe it will help deployment in markets outside of China, where range is key. But also, it performs better at low temperatures for another bonus. On this chart, we've also included another chemistry, NCM613. Though not yet modeled in our battery electric vehicle forecast, this offers a high manganese loading mid-nickel chemistry at similar performance to NCM811. So yet more bullishness on the increased manganese loadings going forward. It's this low cost of manganese compared to nickel, cobalt, and lithium, plus the performance of what it can deliver in terms of energy density, that's driven our bullish view on the potential of manganese in battery electric vehicles going forward. The chart on the right is showing our forecast for the BEV market and high purity manganese demand. Manganese demand is forecast to grow at a CAGR of 16% in passenger electric vehicles out to 2034. By the end of our outlook, we're expecting LMFP to account for 50% of the total high purity manganese demand in this market. And so to put this together on my final slide here and to summarize, we expect that in the short to midterm, ample installed capacity in China will limit significant short-term price rises. There is a surplus expected or a well-supplied market in the short term. Slow PCAM buying is expected to persist through to year end, but the destocking through 2024 means that an inventory rebuild in 2025 will likely support some short-term volatile price spikes in the market. As I say, the high purity manganese market is forecast to be well supplied up to 2028, but the ramping up of new higher manganese loading chemistries like LMFP and NCM613 means that from 2029 and into the 2030s, we're going to need to build out more high purity manganese capacity, either in China or in other regions should an incentive price be in place. I will now hand over to Krishna to talk about cell costs and forecasts.
Thanks, Rob. Now let's look at cell costs using the Fastmarkets Battery Cost Index. On the right here, we have a graph of cell cost in China in dollars per kilowatt hour. Since Jan of 22, cell costs have fallen by up to 60%, driven largely by the drop in lithium prices, which are down 72%. LFP is more sensitive to lithium prices, and LFP CAM has seen its price in China fall by 72% to just $5 per kilogram. And many producers are actually struggling to make a profit on their CAM material this year due to the market oversupply. LMFP is in its infancy, and the cylindrical cells that we've tested have not yet utilized its full potential. Its cost is slightly higher than LFP, but remains lower than NCM and NCA. Currently, LFP can be produced for just under $50 per kilowatt hour, with NCM and NCA about $10 per kilowatt hour higher. Next, we'll look at this in more detail. So right now, LFP prismatic cells are currently around 16% cheaper than their NCM 811 counterparts in China. We illustrate this here using two state-of-the-art cells, an NCM 811 CATL cell and the LFP BYD blade cell. The graph here shows the current cost breakdown with materials and manufacturing, cathode anode separator, electrolyte, other materials, and manufacturing parameters for a 10 gigawatt hour per year production rate. The NCM cell costs $58.4 per kilowatt hour, while the LFP blade cell is at 48.8. The CAM accounts for 46% of the NCM cell cost and just 23% of the LFP cell cost. Aside from the CAM, all other component costs are greater for LFP due to its lower energy density. On the next slide, we present an analysis of how much the blade cell would cost if it were manufactured in different countries, with the CAM also being produced locally and all raw materials being shipped from China. So moving the gigafactory model from China to the US and Germany results in significantly higher manufacturing costs, driven largely by high labor costs in these countries. Cell costs are around 50% greater in the US and 65% greater in Germany compared to China. Cell costs are much more competitive in Hungary and Poland, where labor costs are low. And regarding the US, if the full IRA tax credits are applied, then this could bring cell costs down to $40 per kilowatt hour, which is 20% lower than China. But some caveats. It's unclear how the IRA policy will now unfold with the new administration. And our model here assumes a fully operational, mature plant, which we know the West is really struggling with at the moment. So let's now return to China on the next slide and look at the years ahead. The effects of the coming raw material deficit on cell cost is shown here, where we have modeled 3 future scenarios for the CATL NCM cell up to 2030. And this is based on our long-term raw material forecasts. In the base case, we expect manufacturing costs to fall by 40% between 2024 and 2030 due to increased production and plant utilization rates, reduced yield losses, and more automation, reducing the amount of workers in the gigafactory. However, the rise in lithium, nickel, and graphite price is expected to push CAM and anode costs higher by 59% and 35% respectively, compared to 2024 levels, more than offsetting the fall in production costs. In the base case, we could see the cell cost rising to $68 per kilowatt hour, which would require a greater level of innovation on the pack level to keep costs from rising significantly. Let's look at LFP on the next slide. In the case of LFP, we believe that it's reached a plateau with expected manufacturing cost savings likely to even out the incoming rises in lithium carbonate and iron phosphate prices. Costs are likely to remain around $50 per kilowatt hour in the base case over the years ahead. And this actually has led to many affordable EVs in China that are cheaper than many of their combustion engine counterparts. And this is a huge milestone for the industry. So in summary, falling raw material prices have driven cell costs to historic lows. However, the current landscape is unsustainable as many upstream miners, refiners, precursor CAM producers are struggling to maintain or scale operations. While raw material prices are expected to rise, it's critical now that they stabilize at levels that support downstream OEM profitability whilst incentivizing sufficient upstream supply expansion in order to meet demand. Ensuring stable prices is critical for long-term sustainable growth in the EV sector. And as we can see here, LFP is well placed to absorb the rise in raw material prices and must be adopted more aggressively outside China if we are to see the development of more affordable EVs. Thank you. I'll now pass it over to my colleague Luke to talk about recycling and black mass.
Hello, everyone. My name is Luke Sweeney. I do the battery recycling and black mass long and short-term forecasts. So the first slide we're going to talk about is black mass payables. Black mass is a recycling intermediate. It's what you get when you shred batteries and you refine the valuable material within a battery. The black mass market payables is generally split between two markets, or between two regions, which is Europe and everyone else. If you look on the chart on the slide, you can see that this is for black mass NCM payables, and you've got for the top three lines are South Korea, Southeast Asia, and the United States, where black mass payables are between the 65 to about 75% range. But compared to that, Europe is much, much further behind in terms of payables, which is between 55 and 60%. The huge discount on the European market for black mass is for multiple reasons. The first reason is actually that there's almost virtually no refining capacity within Europe. And what I mean by refining capacity is when you get black mass, you need to then, typically you then put it into a metal refiner to selectively precipitate out the metals within the black mass. So there's almost no refining capacity within Europe. And the second reason is Europe has a different regulatory environment compared to the rest of the world, in the sense that black mass is considered a hazardous waste, and black mass is a dangerous product. So it is considered a hazardous waste. And because of that, the European Union has said that you can't export black mass to OECD countries from Europe. There are also restrictions on how black mass moves within Europe. And there is also lifetime limits on how long you can keep black mass in a certain place for within Europe. And this all affects the black mass payables, and that the price reflects that. South Korea has historically been a very strong demander for black mass, or has a very strong demand for black mass, as well as Southeast Asia. But they both have the markets, the roots of the black mass have different, black mass has different routes depending whether it's going to South Korea or Southeast Asia. For South Korea, it tends to go to it tends to be vertically integrated into battery manufacture, into their battery manufacturing industry. But for Southeast Asia, it tends to go to in the form of MHP payables, which is then which is then exported to China. And actually, just an interesting point is that actually historically, the low metal prices the current oversupply of the metal market means that black mass refiners in South Korea are actually really struggling, and Southeast Asia is typically a very strong market, despite the fact that metal markets have been very weak in the last few months. So the next slide we're going to see is the supply and demand dynamic for black mass. So in the orange bar, you can see the black mass supply. In the purple bar, you can see the treatment demand. So this is the demand from refiners. So you can actually see there's a discrepancy between the amount of black mass that's required by refiners and the amount of black mass that's available on the market. And this is really giving a lot of refiners a headache, particularly in countries which have high labor costs, such as South Korea. And what this has done is that there's been a general push to try and decrease black mass payables, but actually what has happened is, because the market is weighted in the favor of black mass producers, because the refiners are demanding more black mass that's available on the market, the black mass producers have been very resistant to reducing payables. And refiners are in a very tricky position at the moment, because it costs even more money to shut down a refinery completely. So what they're trying to do is they're trying to purchase the minimum amount of black mass they require to keep their operation efficient and productive, in addition to trying to mitigate losses. But actually, over the next 5 years, we're going to see a big increase in black mass supply. And you have to buy one of our products, I'm afraid, to see the rest of the next 5 years. But we're expected to see a big increase in black mass supply, and that is actually because, if we look at our next slide, why we're going to see a big increase in black mass supply, this actually shows that in terms of feedstock, most of our black mass is coming from production scrap. And the reason why is because gigafactories produce a lot of waste when they begin optimizing, because making batteries is quite a hard business, especially when you're new at it. So there's lots of production scrap on the market currently. But actually, as more batteries come to end of life, we're going to see a big shift from the feedstock from production scrap towards end of life, where by 2034, there's going to be 68% of all feedstock is going to be from end of life, compared to 31% currently. Despite by 2034, the recycling feedstock will make up 40% of the metal supply, we're still predicting there's going to be significant demand for additional metal, just because of the amount of raw material that batteries require. And thank you very much for listening. I'm going to now pass over to Paul, who will then conclude the meeting.
Thank you very much, Luke, and the rest of the Fastmarkets team that have presented. So these just summarise what are our key takeaways from this November 2024 outlook. First, looking at demand, we certainly feel the outlook is starting to appear a bit brighter. Global EV sales do remain robust despite the rates slowing, and the ESS market is certainly very much a standout with strong upside. Moving on to lithium, prices during the third and fourth quarter have certainly prompted more aggressive production cuts, meaning the market is starting to rebalance. We expect further producer restraint going into the new year, and combined with improved demand, this will certainly accelerate the shift to a forecast deficit. Looking to nickel, despite the significant production cuts, we still expect the market to register a surplus this year and for that to continue into 25. But from 26 onwards, deficits are potentially going to appear as demand outstrips supply. Looking at cobalt, the oversupply story certainly persists, and elevated copper prices haven't helped incentivizing ongoing extraction of cobalt as a byproduct. Moving on swiftly to graphite, Chinese prices have reached their lowest levels since 2020, and we now see prices that are below the operating costs for new and existing producers. This is clearly not sustainable, and as a result, we do feel that prices will bottom out this year, and then we might see limited support for prices across the course of next year, and certainly some more rebalancing of the market. Considering high purity manganese, our view is of a balanced to relatively well supplied market out to 2028, as there's significant excess capacity sitting in China. Longer term, we remain very bullish on manganese demand due to increasing adoption of LMFP, and new processing capacity will be needed in the longer term. Focusing in on cell costs, excess capacity and the efficiency of Chinese cell production is certainly a major challenge for Western manufacturers, with cell costs about 50% higher in the US and 63% higher in Germany. And then finally, turning to recycling, the black mass market, as you saw, is broadly divided between Europe and the rest of the world. The global undersupply of black mass certainly means that black mass suppliers certainly have a strong negotiating position when it comes to price, but we do expect the balance to tip in favor of refiners towards the end of the decade as the market becomes increasingly oversupplied with black mass due to that rapid growth in end-of-life battery waste availability. And now, just before we go into the Q&A, quickly going to show you a few of our products. Just these are outlooks, but also data that can help you navigate these markets that we've talked through today. We've got the customizable Fastmarkets dashboard where you can find all our price data, news, and also our short-term price forecast for the battery raw materials. The team that have spoken to you today also produce a series of long-term forecasts that provide much more in-depth analysis of the battery raw material markets, supply and demand and price forecasts for each of the battery raw materials we've presented on today, but also we have a copper outlook. Importantly, we've recently launched a dedicated ESS market outlook that provides forecasts for ESS deployments, projected adoption of different battery chemistries in different markets, production costs for ESS cells, and also supply chain insights. And then finally, before the Q&A on the next slide, I just wanted to draw your attention to two of our forthcoming events. First, we've got our Shanghai conference in February, and then we'll be back in Seoul in April for our Asian and recycling battery raw materials event. So we'll now move into the Q&A.
Right, if I start here, we have a question. Any indications, thought on possible policy changes from the US having an effect on cobalt, lithium and nickel prices market-wide? Any thought what that means for the future of availability of EV battery materials in the US? Connor, do you want to start with that? And then maybe maybe Rob, if you follow.
So we've already had some indications from the new incoming government, which has said that they're looking to roll back the consumer side EV tax credit. This will be pretty significantly negative for the US sales industry as a whole. In the absolute immediate term, I do expect to see a bit of a pull forward of demand from Q1 into the rest of Q4, while the tax credit is absolutely going to be in place. It's the potential shift of either removing the manufacturing tax credit for EV cell producers within the US. That's probably my greatest concern. As I mentioned earlier in a Q&A message, the LGES only really made a profit last quarter due to those tax credits. And so the expansion of cell capacity within the US is a lot less guaranteed if that is imperiled. And what happens specifically, because Trump has indicated that towards some producers that there is a possibility for tariffs to shift towards a kind of a location-based manufacturing basis, which is not unlike how the EU plans its EV sales tariffs. And so that would quite significantly change the foreign entity of concern rules that currently kind of govern the US landscape in terms of ownership and in terms of chemistry, because we've seen US manufacturers primarily partnering with South Korean and Japanese manufacturers, Samsung SDI, LGES, Panasonic, while opening up the foreign entity of concern legislation would enable Chinese producers to invest on US soil. That would pretty significantly open the gates for LFP consumption to increase in the kind of budget area, which no Korean nor American cell producers or cathode producers in particular have the manufacturing capacity to create on American soil. So it's, to conclude, it's the location-based changes in policy that are most concerning from a US perspective with the onset of the new government. If it elects to maintain the foreign entity of concern rules while also allowing Chinese investment, it's going to be quite messy. It needs to pick one or the others, particularly in my view.
Just to add on to that, in terms of for cobalt, I guess, yeah, the slower EV adoption in the US is likely to have an impact on kind of the development of ex-China refined cobalt projects. So looking at places in Europe and Australia where cobalt sulfate being targeted to supply the US market. If we have a pullback of some of these IRA, particularly the tax credit that Connor spoke about, this is likely to reduce the idea of a premium price, because of they can't take Chinese material, so it's a smaller pool, and that increases the sort of the economics of a lot of these projects. So overall, it would likely cede ground to China in the refined cobalt market, which in turn could also mean that we start to see greater acceptance and lower prices in Europe as China is continuing to supply the world. So kind of a bit of a mix there. In terms of specifically for cobalt metal, I think the tariffs which are likely to come into place of up to 60% on cobalt metal, it's going to have probably pushing up the cost for US consumers of metal in the superalloy, the aerospace, but at the same time likely have the impact of widening the range in Rotterdam. We'll see probably more Chinese, more Indonesian metal flowing into Rotterdam, pulling down the low end, and the high end is probably going to be more Western brands, which would be applicable.
I think we'll move on. I'll probably ask Will to respond to this when we've got one. Do you think lithium producers might consider using the steep forward curve to hedge out their outputs to secure profitability with spot prices as low as they are? So using the forward curve to support project development.
Yeah, I mean, I think that's it's certainly an interesting idea, taking advantage of the contango to take advantage of the sort of the higher forward prices. You know, it's with the futures markets, they are gaining sort of volumes, they are gaining open interest. So I think, you know, that there is a possibility for that. I think also, you know, the producers having sort of seen the low prices, I think when they see markets turn, they will also be, they will remember how quickly prices moved last time. We don't think necessarily they will move as fast as that time, but maybe there'll be, yeah, there'll be some sort of reluctance to lock in too much. I think it's probably wise to lock in some, but I think they will open. Being producers, they want to be, they want to take the market price as well.
Luke, we've got a question around the sort of future balance between primary and secondary metal supply. I think you alluded to that in your presentation, but maybe you just want to recap.
I certainly did. This is actually quite interesting, where a lot of people, you know, we talk about recycling a lot, and recycling is obviously very important, and we definitely want to keep recycling materials, because if we don't recycle these materials, we will then begin to lose them. But in terms of the secondary metal supply, because we're in such a rapid process of electrification, we are going to need to build such enormous quantities of batteries that the current recycling supply of batteries is, well, the current recycling supply is basically given by the number of batteries that were in existence 10 years ago. And because there are so many more batteries being built now than there were 10 years ago, the recycling supply is expected to make, well, the secondary supply of metals from batteries is expected to be very, very small for the next 10 to 15 years. But actually, when you go to 2040 and when you go to 2050, when you begin to look at these numbers, actually the supply of secondary material from battery gets significantly higher. It then goes to, you know, between, we don't predict these numbers because they're too far ahead, but I wouldn't be surprised if it was anything between 30 to 50% of new materials coming from a recycled supply.
Okay, thanks very much, Luke. We've still got a few questions to respond to, but we're certainly up on time. We'll do our best to respond to those people that have left contact details in the Q&A. Thank you very much for joining us today. If you've got any further questions or would like to know more about any of our products, please do get in touch or visit our website. Finally, we'd also be very grateful if you can complete the short survey that will automatically appear at the end of the webinar. Please do identify any areas where you feel we can improve on the content or highlight new topics that you would like to see covered in the future. Thanks for attending and enjoy the rest of your day.